Welcome to Steady Investing. Today is March 29th. Markets closed this week at their lows. The Strait of Hormuz is still effectively closed. Ships are being turned back, and analysts are now pricing in scenarios where routine transit may not resume for the foreseeable future. On top of that, we have a hard deadline. Trump's extended ultimatum to Iran expires April 6th, just 1 week away. That is the heavy weight the market is carrying right now. But here is the other side of that story. Despite the headlines, there is no fundamental collapse in the businesses these ETFs represent. The world's core needs haven't changed. We still need energy, gold, and infrastructure. What is broken right now is confidence, not structure. That gap, the distance between market panic and business reality, is exactly where our framework lives. Before we scroll, let me show you how to read the context. Each row is one ETF. The binding factor tells you exactly what it tracks. The SIM score shows how identical they are to the group leader. A 10 means they move almost as one. Friday shows the closing mood. 1 week drawdown shows the fall from the weekly high, while 1 week recovery shows any bounce from the low. And here is the most important part. Look at the recovery column. It is 0 across the board. This confirms what we just discussed. No bounce, no relief. These ETFs closed Friday at their absolute weekly lows. We ended the week at the very bottom. Then you have 1 year drawdown and recovery, the bigger picture. How far each ETF has fallen from its 1 year peak, how far it has climbed from its 1 year low. These two numbers together tell you where we are between the high and the low over a full year. And finally, 5 year recovery. This one puts everything in perspective. However bad this week felt, most of these ETFs are still up significantly over 5 years. We'll scroll through slowly. Pause anytime. The detail is there for you to read. Let's go.
Who is this system for? It works best for two types of people. Those with a regular cash flow who can deploy capital whenever the market offers a window. And those with savings they cannot afford to lose. Patient investors who are in no rush. Now, how do you use this? When you make your first entry into an ETF, note both numbers, the drawdown level and the recovery level at that moment. Those are your reference points. From that point on, every day you check the table, you're asking one question. Has the ETF made a significant new low since my last entry? We aren't looking for tiny fluctuations. You are looking for a meaningful drop, typically between 3 to 8% below your last entry price, depending on your personal strategy. If yes, that's a potential new entry point. Small, disciplined, at a lower price than before. You're not waiting for the bottom. You're building slowly, in stages, as the price moves in your favor. Two situations where you might consider adding. First, the ETF is pulling back into a deep correction. Drawdown is growing. Each significant new low is a potential entry. Second, the ETF is making new highs, but still pulling back within that uptrend. Recovery is growing. New peaks are forming. Those pullbacks, while the trend is intact, can also be entry points. This second approach is more aggressive. The first is more cautious. But remember, there is no such thing as a guaranteed bottom. Even the deepest dip can go lower. One more thing before we go further. Not every ETF is worth accumulating. ETFs with strong long-term track records and proven structural trends can be built gradually on pullbacks. Weaker, stagnant ETFs are different. For those, you want to wait for a real bottom, not just a dip. Accumulating into a fundamentally weak or sideways trend is not opportunity. It can be a long test of patience that turns into a trap. For standard ETFs, consider up to 20 separate entries, each at a lower price than the last. To maintain true discipline, treat each entry as one part of a larger machine, ideally aiming for a diversified portfolio of at least 20 different ETFs. This means dividing your total intended capital into 400 or even 800 small slices. After 20 entries, raise your threshold. Wait for a significantly deeper pullback, around 20% below your last entry, before considering more. After that, each additional 10% drop can be a new evaluation point. For high volatility or leveraged ETFs, the thresholds must scale with the movement. A 3 times leveraged ETF needs roughly 3 times the pullback before you consider entry. Where a 5% drop might be enough for QQQ, you'd want closer to a 15% significant drop for TQQ. Because these move fast in both directions, consider scaling out and taking profits just as systematically as you scaled in. Total exposure in any single ETF, no more than 5% of your portfolio. And from the very beginning, spread across multiple ETFs. Don't wait to finish one before starting another. Opportunities are everywhere, all the time. Every decision is yours. This is a framework, not financial advice. Adapt it to your own situation and risk tolerance. We track nearly 300 ETFs every single day. Every pullback, every recovery, every opportunity the market creates. Not to predict, but to be ready. You can't time the bottom, but if you enter small, spread across many levels, you're never fully wrong, and you're never wiped out. If that approach makes sense to you, subscribe. Small positions, multiple entries. Keep your powder dry. Stay safe, stay steady.